Welcome to DoubleLine's first virtual client conference. We'd like to thank you for your continued support of DoubleLine and offer this virtual conference as additional thought leadership content as part of our Client First initiative. We have a diverse agenda, so there should be something for everyone over the next 2 days. When you entered today's session, you should have seen this agenda, which you can customize to attend the sessions of interest and watch others on replay. All sessions will have a replay using this same link. Our overall goal is that both days will start with a global macro discussion leading to market themes, opportunities, and paths to revitalize portfolio positioning. Day 1 invites a lively fireside chat with Jeffrey Gundlach discussing everything from global politics, central bank policies, markets, and inflation protection ideas. Followed up by Day 2's deeper discussion between Jeffrey Gundlach and Felix Zulauf, CEO of Zulauf Consulting, who brings an international focus, furthering the macro insights and idea spectrum. The fireside chat with Jeffrey Gundlach leads into today's portfolio's theme, focusing on sectors that can provide solutions to revitalizing your portfolio positioning and thinking. These themes will include Portfolio Manager and Chairman of the Structured Products Committee, Ken Shinoda, presenting Structured Product Advantages. An emerging markets panel discussion titled Traveling the Globe with DoubleLine's Director of International Fixed Income, Moose Padilla, and Mark Christensen, Portfolio Manager, Emerging Markets, as well as our Global Bond Portfolio Manager, Bill Campbell, and moderator, Valerie Ho. Later this afternoon, we'll host 2 simultaneous sessions, Positioning for Reflation or Inflation, moderated by Yahoo Finance's Julia LaRoche, with Jeffrey Sherman, Deputy CIO and Portfolio Manager, and Robert Cohen, Director of Global Developed Credit. The other session, titled Overexposed to Credit and LDI, is hosted by Portfolio Manager Vitaly Lieberman, who will present a better way to diversify away from corporate credit. Each presentation hosts content related to the session's topic, including speaker bios, social media, webcasts and podcasts, strategy and information, along with public chat about that session. These can be viewed in the theater during the live presentations. All content for every session will be available in the resource library. DoubleLine product specialists, portfolio managers, and relationship managers will be available in the resource library to chat one-on-one or host a call. There is also an option to request a meeting. Some webcast and podcast announcements. If you missed yesterday's international webcast discussion on emerging markets fixed income, low duration emerging markets fixed income, and the global bond, the replay should be up by the end of this week, but you can catch the team's discussion today at 11:45 during the Traveling the Globe panel discussion. Be sure to visit DoubleLine's YouTube channel for our latest videos, including Channel 11. Podcasts can be found on doubleline.com, Spotify, Stitcher, iTunes, and SoundCloud. That includes The Sherman Show and Monday Morning Minutes. And so with that, I will turn it over to Sam Garza for a fireside chat with Jeffrey Gundlach.
Thank you, Ron. Good morning, everyone. I'd like to welcome you all to the fireside chat with Jeffrey Gundlach. My name is Sam Garza. I've been a portfolio manager with DoubleLine Capital for since the inception about 10 years ago. And over that time period and beyond, I've had the great privilege of working with Jeffrey Gundlach for going on 20 years now. And so it's my pleasure to welcome to this virtual fireside chat CEO, founder, and CIO of DoubleLine Capital, Jeffrey Gundlach. Jeffrey, welcome.
Thanks, Sam. I'm looking at the screen. I see that somebody has put on a painting by Piet Mondrian. It's not a typical Piet Mondrian painting, because usually they're the neoplastic stuff that are all the, like the Partridge Family bus kind of look. But this is a flower painting that he did prior to being enlightened by Picasso's minimalism, and he took it a few steps further. But it's interesting to see that flower painting. Congratulations for picking it. I think it's a clever idea.
Well, I certainly had some help with that. I could take all the credit on that. I'd like to just dive in a little bit into the first slide, and we'll still see this painting in the bit of the background here.
All right.
We've been in this, I'm going to sort of dive right into it. A little bit of history first, and then we can talk about the current markets. We've been in a very long bond bull market. I've got a chart posted here that is going quite back, and we're looking at the economic growth and declining bond yields over a long period of time. And one of the things that sort of strikes me about this, and you've been in the market really pretty closely since the bond market became a rally. There's certainly been a lot of trials and tribulations, but over this time period, bond yields have come down pretty dramatically from the early 80s until now. I'm wondering if you have any interesting, memorable experiences. I know you do, that really sort of highlight some of the most important points of maybe an opposite reaction in the bond market. I'm thinking more of like 1994 taper tantrum, or even 2008. There's been some really interesting developments over the bond market over that time period. Is there any memory that really strikes you, sticks out to you? I know sitting on the trading desk, since the time that I've started at DoubleLine, there was a lot of talk about 1994. I'm curious if the events of the last 10 years, be it 2008 taper tantrum, or even last April, what to you stands out the most as the most interesting bond market experience, be it a good bond market or a bad bond market experience?
Well, let's start out with when I began in the financial markets, which was basically about 35, 40 years ago. And what was really interesting when I entered the financial markets is bond yields were really high. In May of 1984, May 31st, 1984, the long bond yielded 14%. And that sounds pretty high by today's standards. But more remarkably, the inflation rate at that moment, in May of 1984, the inflation rate was 4% on the CPI. So there was a 1,000 basis point real yield on bonds, and nobody really wanted them. Everyone called them certificates of confiscation, was what they called bonds, because all you did was lose money on them. And remarkably, people did not believe that the 4% inflation rate was going to sustain. They thought for sure that inflation was going to come back because it had been so pernicious with the gas crisis, the oil crisis, the guns and butter policies came back to haunt the United States from Lyndon Johnson into the mid-'80s. And interestingly, only one client that I had saw the 1,000 basis point real yield as an advantage. And what was really interesting, they locked in a 14% yield, which was, their actuarial rate was 8. So they had a 600 basis point guaranteed excess return from the long bond versus their actuarial rate. So they were very smart. But what ended up happening is when the bond yield dropped to around 10, they thought, this is just a windfall profit, I'm getting out of it. So people thought that bond yields in the single digits made no sense at all back when I started in this business. And inflation did nothing but fall from there. It was never 4% again on a year-over-year basis until today. This very day, we now have a 4.2% year-over-year CPI. And the core CPI is at 3%, which is the highest since 1996. So we're in exactly the mirror image of where we were when I entered this business. Now we have a bond yield on a 10-year that's it's about 250 basis point negative yield versus the inflation rate. And people think that inflation is not possible. And we're in an environment today where the Federal Reserve and the Secretary of the Treasury, Janet Yellen, who's really part of the Federal Reserve in a certain closet sense, is saying that the inflation rates that we're seeing are transitory. How do they know that? How do they know that they're transitory? The government is pumping massive amounts of money. Stanley Druckenmiller, who I have great respect for, is talking about the perils to the dollar's reserve currency status based upon the Fed's strategy. and we have wildly distorted markets based upon government manipulation. So yeah, the market strikes me on bonds as being extremely vulnerable to a change in the narrative that the inflation rate is transitory to one there maybe it's going higher. Today the CPI came out, and I'm not sure 1 month is the sign of a trend, but the inflation rate based on the last month is now at 10% if you analyze the 1 month number. And I know it's about base effects, and everyone's talking about, you're comparing it to a very depressed scenario from the pandemic's evolution 1 year ago. But it strikes me as being the mirror image of that 1984 experience, where now you could have not 1,000 basis points of real return, you might have something approaching 1,000 basis points of negative real return. And so we're in a situation that is really, I would say it's uncharted waters to the same extent that 1984 was uncharted waters. You never saw 1,000 basis point real return from the long bond. And interestingly, nobody wanted it when it was 1,000 basis points, and everyone seems completely copacetic with owning junk bonds that yield to no default, something like 4%, owning treasury bonds at zero yield on the short end, and a paltry, like 1.6, 1.65 on the 10-year treasury. And so we're all dealing with, as investors, a sort of a menu of options, which is extremely paltry. So I'll just sort of end there. We look at this chart that you have on the screen, you see that long decline in bond yields. I am pretty sure that we've seen the low in bond yields. I've talked about this at great length over the past year, that the long bond, interestingly, the 30-year treasury bond, bottomed on an intraday basis at exactly 1.00%. It's almost outre that it would be exactly 1.00, so it's easy to remember. And today we're already up about 140 basis points on the long bond. So people that own the long bond are owning a negative return of pretty strong significance since that 1% intraday level was reached. I mean, you're talking about losses that are stock-like, stock bear market-like in terms of price losses on long-term treasury bond. And the only buyer of treasury bonds at the present time on a net basis is really the Federal Reserve. So we're living in truly interesting times. And as the Chinese proverb, it's a sort of a curse, may you live in interesting times, but as investors, that's where we are right now.
I'm not sure how much that will be quoted in the coming years, given what happened in 2020. I certainly don't wish to live anything more interesting than 2020.
It's like every morning I wake up and I'm afraid I have to look at the news every day because it's essential to running my business. And I'm almost afraid of what the next bizarre headline is going to be every morning. And we're the rate of change of the society, I would say, just continues to accelerate. I've been talking about this. Sadly, I predicted all of this, as my long-term investors know. I've been predicting where we are today for a very long time. I wish I was wrong. When you predict something and it comes true, you feel like you're supposed to take a victory lap or something, but I don't feel anything like that. I'm sad that we've devolved to where we are. And I've talked about this for a very long time, really almost 25 years, that we get to a place where the old traditions fail and we have to find a new level place to stand. And until we find that level place to stand, we're dealing with a lot of societal discontent. And I just think that's obvious. It's not a prediction, it's just a fact of where we are right now. And we all have to try to get through it. I try to be optimistic at the end of it, and that is that several years from now, we actually will be in a really great place, I think, but we have to sort it out in the meantime.
That makes a lot of sense. So much of what you just said, I want to come back on, particularly the pandemic, but I want to stop. You brought up the inflation. Obviously, today we had a pretty significant inflation print. We developed, as you know, for our macro meetings internally at DoubleLine, this nifty little inflation forecaster that really allows us to see months ahead moves in inflation, particularly based on base effects, as you know. And so we've been we were aware that we were going to have this rise in inflation, largely, at least based on our analysis, led by base effects. Of course, there's a lot of other factors now that we can look at. I'm going to jump to a couple slides that just highlight this. I just selected a couple. As you know from our weekly macro meetings, there's chart after chart that has the look of what I'm about to sort of slide on. One is the rising inflation for expectations. Now, our slide, we made this deck yesterday, so we didn't get to include the data from today. We did take an internal poll of the investment team a couple weeks ago, and we asked the question, do you think the rise in inflation is transitory? You touched on this. 2/3 said yes, about 1/3 said no. I think the answers, to me, that feels like what, if you ask the market, it might be something like that. 50-60% might say transitory, maybe higher. Maybe it's higher than that. I know it's early. You look at a chart like this, and I'm just going to, move on to another chart as well. And this is looking at inflation. And again, this is a little bit stale given what we've seen today. This is looking at ISM prices paid, leading CPI. And I'm coming to a question. I just want to highlight one more slide here. And this
just go back to the other one, because it's fascinating, because you look at the blue line and it's leading indicator, and it shows, hey, the CPI is about to spike higher. Well, talk about a chart that's incredibly helpful. I mean, the CPI print today is 4.2. Look at that blue line. It's 4.2.
Yeah,
it's exactly predictive. It worked exactly perfectly. So it'll be interesting to watch the ISM prices paid in the future, because as your eye can see, there's a tight correlation. But I'm struck by the fact that the blue line was exactly predictive of today's economic release.
So the big question, and I'm going to ask a question that you probably won't have an answer, or you won't have a definitive answer, I should say. Have you started to form an opinion on whether yourself you think this is transitory or not? I know it's a probabilistic answer, and it's probably too early to tell, but what is your current thinking about that question as we push and look through charts and data points like this?
I really don't know the answer to whether it's transitory or not. And I think anybody that says it's transitory, or anybody says it's not transitory, is just putting their finger up and trying to see how the wind is blowing. They don't really know. But it's fairly clear that, to me, that some of this inflation is based upon the government's money printing policies of giving money to everybody. In New York State, if you're not working, you're now getting over $57,000 a year tax-free. California just announced, Gavin Newsom just announced that the $56,000 and change that you're getting for not working in California isn't enough. He's going to give you another $600, and if you have a child, I think it's going to be $1,100. So we're in a race to see which state can give you the most money for not working. And of course, the employment report last Friday, I think, was a game changer, because it finally, it was a cold bucket of water on everybody. That when you go to this type of monetary fiscal policy, zero interest rates, and 56% of the federal spending, there's $8 trillion of federal spending, a little over $8 trillion over the last 12 months, and 56% of it is borrowed, which means lent sort of by the Federal Reserve. The idea that that sort of a policy would not have consequences, I think, was really debunked last Friday, when people expected 1 million jobs, and we got, with revisions, almost no jobs when you revised the prior months. And people are surprised that, people don't want to go back to work, because median household income is very close to the amount of money you get for not working in the two largest states in America, California and New York, and also Chicago and Illinois aren't very far behind. And so no wonder. So it seems clear to me that the government's endless distribution of free money must be really inflationary. So if you want to believe that inflation is transitory, you have to believe that the government's policies are transitory. And it's getting hard to believe that because, as I just said, just this week, we have a new money giveaway in California. And of course, everyone points out historically that California is kind of the pace car that leads the nation. And the way that California is going is not encouraging if you want to believe that inflation is transitory. So we're in a very strange situation that if the government stops with the distribution of free money, there will almost certainly be an economic collapse, because all of the economic growth in the United States over the past 12 months since the pandemic started, 14 months ago, I guess, all of the economic growth is borrowed money, all of it. There wouldn't be any GDP growth whatsoever if it weren't for the government giveaways. So we're in a completely contrived situation. And as long as the government keeps sending out this money, inflation's going to go higher. And I talked in my Total Return webcast back on March 8th or so, that the bear market or the decline in gold was over. And I think I nailed it on that webcast literally to the day. Gold's been rising since then. Bitcoin's up at, it stopped rising, but it's up at 56, 57,000. I don't know how to pronounce it. Elon Musk's favorite thing, Dogecoin or Dogecoin, however you pronounce it, is up like 1 billion %. This stuff is not. This is not normal. Not a normal situation. And until such, so the government has the economy kind of like a tiger by the tail. If they keep printing the money and sending out checks, they're going to cause inflation. It's already happening. If they stop giving out the checks, there's going to be a massive economic contraction. And so we've got to watch this with laser focus, and we're all hostages to the whims of our so-called elected officials. So that's where we are today. And this ISM prices paid, everywhere you look, people are saying they're raising prices. CEOs are raising prices. Warren Buffett is talking about raising prices. I've been traveling a lot over the past 12 months, surprisingly, because of the COVID situation. But I'm traveling a lot, and everywhere I go, I talk to business people at the Lowe's store or construction workers or anybody that I run into, and I say, how's your business going? And they say, I can't get workers. I have to pay more for workers. And so when people talk about inflation, they often say, well, there's not ever an inflation problem unless there's wage inflation. And I think that's right. I think it's a fair statement. But wage inflation, if you can't find workers, it seems to me that you're going to have to pay more for workers. And so I think I started out this conversation, Sam, talking about 1984, and inflation was low and yields were high. Now it looks like inflation is coming back and yields are low. And so that's a fundamental starting point for thinking about investment allocation.
Absolutely. When I look at these charts and I hear what you have to say, it makes me, there's a part of me that sort of wonders if the animal spirits of inflation can get unleashed, and maybe inflation might otherwise be transitory. But if, your local contractor is having to raise, wages to hire contractors, and to hire construction workers, and those construction workers have more dollars in their pockets and they are willing to buy more, and so on through the entire system, it seems like there is some capacity for this sort of, to become this multiplier effect of inflation that is really hard to sort of calculate or have an opinion on. It's something I guess we have to wait and see.
Today, the CPI came out at 4.2 year over year. But one of the things that's important in the CPI is the cost of shelter, home prices, and owner's rent equivalent. And they use owner's rent equivalent, and I think that's up like 2% year over year. But home prices on average, in the United States, are up double digit year over year. I think they're up something like 16, 17% on an average basis year over year. If you use the home price instead of owner's equivalent rent, the CPI, shockingly, over the last 12 months would be 8%. And interestingly, it's almost like bizarre. When I was in high school, we were living through the Jimmy Carter years, and there were gas lines. You actually couldn't buy gas other than every other day. It was based upon the number on your license plate. If it was an odd number, you could buy on Tuesday. If it was an even number, you had to wait till Wednesday. We had what were called gas lines. With this hack of on the East Coast, there are now gas lines. You can't buy gas in like North Carolina and down in Virginia. There's no gas. So it's kind of interesting how we're right back to some of the conditions, obviously for different reasons, but the conditions seem to be reminiscent of the Jimmy Carter era. I'll also point out that under Jimmy Carter, we had the hostage crisis with Iran, where they had the U.S. embassy hostages for a long time. And so here we are with missiles in the many hundreds going into Israel from the Palestinians. It's looking a lot like Jimmy Carter days, yet the bond yields versus inflation are exactly the opposite. So I think people have to like open their eyes and start to realize that, you know, we're not in Kansas anymore, to use the Wizard of Oz thing. And things are going to get very, very interesting, if they're not interesting enough already, in the conditions that we have to deal with.
Well, speaking of interesting, and you mentioned it before, here's, and I'm going to say it wrong too, here's a chart showing Dogecoin, and in the lower panel, we added a GameStop, which there's a lot of news about, it was a couple months ago. When I think about this past year, you know, the pandemic, hopefully once in a generation pandemic, so much has been, you know, sort of not a shock to the system, but maybe literally a shock to the system. But there's been many surprises, many things that if you asked me a year ago, I'd be quite surprised the way things played out. I could talk about what's happened with Bitcoin prices, baseball card prices, equity markets, pretty much every asset up. The amount of checks going out to folks and things like that. Looking at a chart like this, what do you make of the, I mean, I titled this chart Revolving Door Speculation. I couldn't think of a better, you know, title, but there's these waves of money flowing into these different assets. It's been a very bizarre, almost gamification of investing in some ways over the past year. What is your take on, you know, things like Dogecoin and GameStop and, you know, insert asset X into the plot?
It's a mania. I mean, it's obviously a mania. You throw enough money into people's hands, and they're sitting at home, and they're tired of binging on Netflix, and they can't. For a long time, they couldn't go to the casino, and so they find the outlet in these areas of speculation. The chart that you have on the screen right now is very interesting because you have a vertical rise in this cryptocurrency, yet it kind of looks to me like it peaked out. I mean, it's kind of crashing. And I think you always have to look for the pace car of speculation. And these cryptos are sort of the pace car. GameStop, you'll notice that at the bottom panel, GameStop peaked out a long time ago. So one thing that is useful in investing, and it sounds overly simplistic, but it's incredibly important, is you have to pay attention. Pay attention to what's happening and look at the pace cars. And these pace cars look like they've kind of running out of gas here. Now, can these cryptos go up another 100%? Of course, anything's possible. But I look at look at the what we talked about last summer. Seems like a million years ago. I did webcasts and I talked about the Super Six. You know, the Netflix, the Facebooks, the Twitters, the Apples, the Amazons. I mean, they're not looking that good anymore. They're not leading on the upside. A lot of people that want to be bullish about stocks, they say, well, look, I mean, you've got a new 52-week high is relative to the stock market. Stocks that their 52-week high is actually expanding. But that's because the little guys are picking up. It's not the Super Six that are leading anymore. As I talked about last summer, when the generals, which were leading the charge, were the Super Six, and the generals seem to have left the battlefield. And I talked about this last summer. And we go further into areas of speculation. And what's on the screen now with Dogecoin, or whatever, however you pronounce it, it's not really looking all that enthusiastic anymore. And so I'm struck by, when I get up in the morning and I look at the movements in the overnight markets or the U.S. stock market, I'm struck by how inconsistent the movements are. You'll have a day where the NASDAQ drops a lot, but the Dow Jones Industrials go up a moderate amount. And then the next day, the Dow Jones goes down 400 points and the NASDAQ is flat. There's incredible lack of consistency in the movements of the stock market averages. And the other thing I've been talking about really since last summer is how the U.S. Stock market is no longer really outperforming the rest of the world. It had been, as we talk about in our weekly meeting incessantly, it had been that U.S. stock market was outperforming the rest of the world by a massive amount since really 2011 or so. Really like triple the return of the non-U.S. stock market. And that's not happening anymore. And you'll notice that the dollar is not going up anymore. In fact, the dollar is now near its local low of recent years. And there's the chart right there. And dollar down at 90.5. One thing that is central to my longer term investment thesis that I try to recommend to people is I am positive that the dollar is going down. I think I don't know if I've ever been more positive about something. Maybe in 2006 when I was super bearish on the U.S. stock market, I was as positive as I am now on the dollar. The dollar is doomed with these policies that are going on, with the trade deficit expanding tremendously thanks to the stimulus. I mean, it all goes to China and Southeast Asia. Everything. We have a consumption boom, but we don't have a production boom. We have a consumption boom. And so the benefits, if you want to call them that, of all of this stimulus go to our trading partners. And when you have the trade deficit expand, that's negative for the dollar. And when you have the budget deficit expanding, which is an understatement. I mean, the budget deficit is not expanding, it's exploding. Those are very negative for the U.S. dollar. And I talked about Stanley Druckenmiller a few minutes ago, who I greatly respect. He was on the tape yesterday talking about the dollar's reserve currency status is in jeopardy because of our policies, and he's absolutely positively correct. So we're looking at a situation that is very negative for the dollar. And so non-U.S. markets are probably more attractive than the U.S. market in the stock realm. And that's particularly true, I think, of the Asian stock market. But as you know, Sam, in our macro meetings, we actually turned positive, modestly positive, on the relative performance of European stocks versus U.S. stocks for the first time since we started DoubleLine nearly 12 years ago. We actually have a more positive view even on European stocks, and it's all based upon the dollar. The dollar seems like doomed to me based upon the actions that are causing the trade deficit and the budget deficit to expand so dramatically.
Yeah, one of the things I've been thinking about with the dollar and fiscal policies is, of course, a number of countries are doing what I would have called unorthodox fiscal policies before a year ago. In your eyes, to your framework, is the dollar more vulnerable because it is the reserve currency, therefore it has sort of more to lose, and maybe we're doing, we have this trade deficit that you've referred to, but feels like there's sort of this race to the bottom that I feel like we've been talking about for a long time, and it just got accelerated in the past year. But what about the dollar to you feels more vulnerable, versus other currencies than, the euro and the yen, who are
well, the dollar. You point out correctly that the dollar and the U.S. markets, the United States broadly, has benefited by having the global reserve currency. I mean, when you have that position, you have an advantage over everybody. But it seems quite clear that China intends on getting a seat at the table on reserve currency status. And all indications are that they're on the path to succeeding at that desire. China's economy is going to eclipse, in terms of GDP, the U.S. economy in the next few years. There's two things that I find on a parallel track that it's just interesting. Years ago, there was forecasts that the Social Security system would be bankrupt by the year 2050. And then it got rolled back to 2040, and then it got rolled back to 2030, and now it's like in a few years. The other forecast that was in parallel with that was that the Chinese economy would eclipse the size of the U.S. economy by the year 2050. It was like exactly the same time frame prediction. And then it was 2040, and then it was 2030. And it's kind of looking like the Chinese economy is going to be at the same size as the U.S. economy in the next several years. And China has also made it fairly clear that they intend on having a larger military than the U.S. in that same time frame. And China has a tremendous savings rate. I mean, saving is like the national pastime in China, and borrowing and spending is the national pastime in the United States. I mean, there's no product that is more heavily advertised and promoted than credit cards in the United States. It's almost like a coming of age. You finally have become like an adult when you get your first credit card. But of course, now you get a credit card when you're 6 months old. Literally, there are credit card stuff that is sent out. I know people who have received credit card solicitations in the mail for their 6-month-old child. So China, with their savings and with their economic advantage, thanks to the United States trade deficit, and with their military growth, I think you're just an ostrich with your head in the sand if you think that China is not on the ascension and the United States is not on the decline on a relative basis. So these are very big issues, and the Chinese economy is the strongest economy in the world thanks to United States stimulus. When you give money to people and you actually are shutting down your productive capacity with lockdowns, and you give money to people on I don't even know what it is it 6 trillion now for the last year? I'm losing track. So when you do that, what happens is you have a lot of things that say made in China on them go through Amazon, and they get a markup, and we have an economy that is so unhealthy that it's shocking to me that people use the word. I hear it all the time, even our own investment meetings. Some of our people call it U.S. exceptionalism. What's that supposed to mean? U.S. exceptionalism? We're exceptional? Well, we're exceptional in terms of our stock market performance over the past 10 years, not in the more recent period, but the last 10 years. But how is being a deadbeat economy exceptionalism? It's a very bizarre phrase. I would say it's anti-exceptionalism. So I've been a strong advocate of investors making allocations incrementally on a consistent basis away from the United States. And it's painful to say this because, I'm U.S. my whole life, through and through. But you gotta, in investing, you have to accept reality. The way people screw up in investing is they're in a position and they want to believe that it's good. And so they use a filter on all the data that's coming through that makes their position look good. But hope is not a method. When I was back in my rock and roll days, when I was writing songs, there was a brief window where I was both an investor in a profession and doing rock and roll, and I was in a bad position relative to the bond market. I was long the bond market in a big way, and it was dropping and dropping and dropping. And I knew every morning when I looked at the data, I just knew it was going to be down again because it was just such a powerful trend. Yet I was still long, and I realized that all I was doing was wishing and hoping and praying that the downtrend would stop. And I realized that that was not a good strategy. So I wrote a song called "Wishin', Hopin', and Prayin'" to kind of process the fact that I needed to close out that position and stop dreaming that the trend was going to change, because it wasn't going to change. And so that's how I feel about the relative investment position of the United States versus the rest of the world right now.
That's interesting. Thinking, you're listening to you hear that tell that story, it makes me sort of wonder. I can imagine a lot of investors may not learn that lesson, may end up, perhaps repeating the same mistake over and over again. What is it about you in the way that you sort of view the world that you think you're able to sort of self-correct early on? Was it having interest in music and other areas? How are you able to sort of, think about things a little bit differently, maybe out of the box, which I've observed in my career many times. But you definitely, I would say, have this ability to look at things from different perspectives. And clearly you just gave an example early on.
It has a lot to do, it has to do with memory. I have a very good memory, so I can recall data and stuff, but it's beyond that. It's more of a emotional memory. I mean, I've made every mistake that you can make in the investment business twice. There's probably 2,000 mistakes you can make. I've made every one of them probably twice. But I also remember making them, and I have a way of I remember how it feels to make those mistakes. In other words, that I'm in a bad position or something's going on in the market, and it's like, oh, I've seen this before. I'll never forget 2007, where the subprime thing started to infect everything. And there was non-agency prime mortgage securities, which had never really traded below par. They had credit exposure, but it was perceived to be de minimis. And they were AAA rated. I remember they were coupon of 6. They were trading at par, and they always traded around par. There was really no volatility in the middle. And then the default started to happen in subprime, and Ben Bernanke was completely wrong. He said it's not a problem at all. It's just subprime. Of course, it was the entire mortgage market was a disaster because of the ridiculous deterioration in lending standard. And these securities started to drop in price because people were forced to sell on margin call, who were leveraged investors and mortgage REITs primarily, and other financial institutions. So the price of these securities started to drop. And of course, that creates more margin calls. Well, it starts a vicious cycle. So the price of these securities went down to like 98, from 100 to 98. And one of the best mortgage REITs in the entire country had a problem, because not because their lending standards were actually excellent. Their mortgages were actually very excellent in terms of their quality, but they were too leveraged. And so they ended up getting a margin call. So one Friday afternoon, a list comes out because they're getting margin called, and there's hundreds of millions of dollars, maybe even billions of dollars, of these totally fine securities that were being sold into the market at 3 o'clock on a Friday, which is a pretty bad time to be selling stuff because, the trading desks are pretty thinly staffed. And so they come out and they're talking the bonds on the margin call list at 97. And I say, okay, I think 97 is too high. I know what margin call situations are like. I'm going to put a bid on of 93. And the dealer that I went through says, you're out of your mind. They're never going to trade at 93. I mean, come on, we're talking about 97. So I put a bid on 300 million bonds at 93, and I get hit in a New York second. It's like, you own them. And I was hit like a bolt of lightning because I was like, oh my God, that's what I thought in 1994 when securities went from 100 to 80, and I thought they were ridiculously cheap, but then they went to 40 after that. Because when you have a liquidation cycle, the prices go to levels that are historically remarkable. I mean, you can't believe it. I mean, the securities in 1994 were so cheap that the bond yields were at 6 or 7%, and there were securities that were government guaranteed that, to their worst case scenario, needed to yield 16%. Worst case scenario, absolute worst case scenario, yielded 16% to clear the market. And I realized back in 1994 that value under a liquidation cycle doesn't matter. Somebody has to open up their wallet and buy them, and there aren't enough wallets out there. And so the prices can get to amazingly depressed levels. So in 2007, I had this bolt of lightning go through me, and I said, we are not buying any of these again, because at the 93 price, they yielded 8%. And that seemed really cheap compared to where treasury yields were. But I said, we're not buying any of these. I said, mark my words, these are going to go to yields in the teens. And I told Vitaly, I said, I want you to sign the trade ticket. Back in those days, we had paper trade tickets. I said, I want you to sign this trade ticket that this is the cheapest bond I've ever seen. Because mark my words. And of course, they went down to the price of 45 in the credit crisis, which was, I was wrong. They didn't go to yields in the teens. They went to yields of around 30% to no losses. When he loss adjusted them, they were yields in the 20s. So one thing that's really important is to have that, I think, if you can develop it, that emotional memory, as well as a factual memory that says, oh yeah, I've sort of seen this movie before, and it's never exactly, Rocky 12 isn't exactly the same as Rocky 1, but it's very, very similar. And so these market meltdowns have that same effect. And I think what happened last March, April with the pandemic was another example of things getting absurdly cheap. But we're in a world now where the government decides what level asset prices are supposed to be at. And so that metric is still in place. So the thing is to remember and to admit that you've made these mistakes before and try not to make them again. I haven't made any of those mistakes in a while. I hope I don't do my third round trip on making the 2000 mistakes over again.
No, I don't think that's possible. And it does seem like the ability to connect the dots between the past and the present is very valuable. Certainly in the examples you brought up. I think we're going to have just one more topic here, and then there's a couple of questions I'd like to sort of wrap up with. And this one's about the debt, and you talked about 2020, and you've referred to during this talk about the government action. The chart I posted here is the increase in global debt since 2019. Debt has increased globally dramatically, whether mostly government debt, but also corporate debt as well. And I know we've talked a lot about this, and we have endlessly talked about this in our macro meetings. And I really feel like we've been talking about this for a couple decades, and things kind of went exponential over the past year. as you look ahead, how do you think this plays out? And maybe you've alluded to it already with the dollar and so on, but it feels like we're in a global debt boom that just went massively to the upside. What is your thinking for how this might play out over the coming years? And on the backside of that,
we need to reset the whole system. I've been talking about this, sadly, for 20 years at least. And back in 2012, 2013, I said to all of on my webcasts and the like, I said, I've got excellent news. I've been talking about this long trending problem. But here in 2012 or 2013, I've got good news for you. It's not really going to be a problem for the next several years, because we actually, when you look at the compounding tables of the entitlement programs in the United States, the debt and all that stuff, it actually looks like we have a level place to stand. And I said until around 2018, 2019. So I'm going to say that was an accurate prediction. And so now we've got, we're right in the teeth of the compounding problem. And it's just going to keep getting worse. And the charts that you're showing obviously show that. And it's clearly not a strategy. Running it this way is not going to work. I mean, I go back to, and I don't want to be hyperbolic, but it is an interesting analogy. I go back to about 1775 in France, when France had a debt problem that looks a lot like ours. They were on the gold standard, they went off the gold standard, they went to a money printing program. And what ended up happening was the people who were so-called middle class became impoverished. The people who were previously impoverished started starving to death. And the people who were controlling the levers of the money printing became incrementally even more wealthy. Well, by 1789, it was so bad that there was a shortage of food. And the price of bread was prohibitive, and there was even a shortage of bread. And so there was this moment where in the bread market, the women who were patrons of the bread market couldn't take it anymore. And they essentially revolted. And they started to march towards Versailles. And the distance from Paris to Versailles, if I remember right, is about 14 miles or so. Maybe it's a little bit different, but it's something around 14 miles. And these women, and they were joined ultimately by thousands, if not tens of thousands of people, walked from Paris to Versailles in a torrential downpour. I suspect many of them didn't even have shoes. And they walked to Versailles because they'd had enough with Louis XVI and Marie Antoinette. And they went there essentially to kill the king. But they didn't kill him. They ended up getting persuaded to lower their temperature a little bit. And they ended up putting him on a cart and dragging the king and Marie Antoinette to Paris. And they put him in some historical building, which was essentially, they were there imprisoned in 1789. And of course, in 1793, I guess it was, the guillotine came out and they started murdering everybody. And so you had this massive French Revolution, and they had to reset their society. I hate to be sort of alarmist about it, but that seems to be sort of the path that we're on. Whether it has to end in a revolution, I don't know. Whether it has to end in a reset, I'm positive. We have to reset the system. We don't have a system that's stable and organic and productive. It needs to be reset. And I've talked about this a lot over the past several years. And I talk about my friend Neil Howe, who wrote the book, The Fourth Turning, who predicted correctly the timing of the credit crisis back in 2000, in the mid-00s, that societies go through cycles. And we're in the fourth turning, which means that the institutions that were created in the aftermath, really, of the Great Depression and World War II aren't working anymore. And it's just so obvious that that's the case. Who can deny that when you read the news and you look at the fact that there isn't even a consensus on what the facts are anymore in the news? which shows that nobody is buying into the institutions. And once the institutions lack credibility and buy-in, you need new institutions. And that's what's going to happen, and it's clearly happening. And you have the wealth inequality, a representation of wealth inequality. Wealth inequality is the outcome of money printing. Amazingly, it's designed, it's intended to be the opposite. Money printing is designed to solve wealth inequality by giving money, that we're doing right now, incrementally once again in California, giving money to people who are the have-nots, but it doesn't work because you're not increasing the productive capacity of the economy. So all you're doing is creating greater distortions, and we need to stop doing it. To do that, though, requires resets in a lot of institutions. I mean, you look at every institution, people don't believe in Congress. They haven't believed in Congress in many years. The approval rate of Congress is lower than the approval rate of murderous dictators that run third world countries. So there's no buy-in there. You look at surveys regarding religious institutions, they're at new lows in terms of their membership status. These things all have to change. The Bill of Rights, the first 10 parts of the Constitution, there are significant leaders in Congress that have stated publicly that they wouldn't vote for the Bill of Rights. They would eliminate parts of the 10 amendments. So there isn't even confidence in the founding documents of the Constitution. And when you don't have confidence in the pillars of your government, your religious institutions, and so on, you need to change them. The good news that I have for our viewers and listeners today is they will change, and we'll go into the first turning. And the first turning will have tremendous buy-in, tremendous possibilities, and tremendous harmony in society. But we have to go to that place. And that's where we're going. And when you look at, we started out with the negative bond yields versus the real yields versus the positive real yields. We have to get to positive real yields. We've got to get to places where there's a like I say, a level place to stand. We're going to get there, but we have to go through that transformative period. And anyone that thinks that we're not in that transformative period is wishing and hoping and praying. They're not processing reality. And what we're trying to do is process reality and take our investors to that first turning with the most comfortable experience possible, given the tumult of the times that we're in.
As CIO of DoubleLine, what are some of the strategies you think, knowing we're going through that we can take? I guess the first one is awareness and knowing that here's where we're at and being agile and flexible.
Well, I've been very positive on commodities for really the course of the past year or two, and it's starting to work, and I think it's going to continue to work. I think commodity prices are going to go a lot higher. That's part of my negative dollar view. The chart you have on the screen now is one representation of how ridiculous the outperformance of stocks are versus commodities. One that I like to look at is one that was produced by Goldman Sachs, and I've used it in some of my webcasts over the past several years, and that is just the total return of the Goldman Sachs Commodity Index versus the S&P 500, and it goes back many decades. And that chart shows a remarkable cyclicality, and that is that the value of commodities versus the value of stocks goes through this cyclicality that is remarkably repetitive. So you go from a situation where commodities outperform stocks by about 8x, and then you go through times where commodities underperform stocks by about 8x. And where we were a year and a half or so ago, commodities were at the nadir of that relative performance pattern. So that commodities looked poised to have a tremendous outperformance versus stocks. And of course, that has already started to happen. But as this chart shows, look at the blue line, which is commodities. You barely see it. The scale is so huge that the move that's happened, which is a very big move, doesn't even look like very much. But I think commodities, which are real assets, will outperform financial assets by a very large amount. And so I've been quite positive on commodities, less so on gold, although I turned positive on gold on May 8th or 9th, and it's rallying. I think gold will do well too. But I just think you need to own real stuff, because what we're doing is we have inflated the value of the financial stuff so much relative to the real stuff that it's time for a trend change. It's already started. You can see it everywhere. You can see it in the prices of housing, which we talked about earlier, which is up tremendously. But look at that blue line. I mean, the distance between the blue line and the red line is truly incredible. And you'll notice that in the starting point of the chart that's on the screen right now, commodities and stocks performed identically for a long time period. And then suddenly the divergence became striking. Well, I think that these trends are going to revert. And I'll bet that before I retire, that the red line and the blue line will be exactly in the same place.
This was the question that I was going to ask related to this, which I think you've just answered, is taking a look ahead, thinking about all that we've talked about, the transition that we need to go through. What investment as a big bucket would you prefer over the medium to long term? And it sounds like, at least of these three, certainly sounds like commodities is the one. Commodities and
my favorite investment actually is farmland right now. That's not an easy thing to execute for most people, but farmland is essential to human existence. I mean, unless we start doing laboratories on Mars that the Elon then ships back to the United States or something. But I think farmland is it's been very it's underperformed by a lot, and it has real value to it. And so it's that type of a thing that I think is an excellent holding, and that really, of course, that filters into commodities broadly. But I think there's a lot of room on the upside for these real assets. And if you want to be in the casino with your cryptocurrency, I mean, there's certainly a thesis that can go to infinity. But I'm too old for that, I guess. I prefer the stuff, I prefer the stuff that's real. So that's what I'm doing personally, that I've been doing for a long time, and I really have that red line on the screen. I mean, I hear people saying this is the beginning of a new huge bull market. Really? The beginning of the bull market looks to me like it was a long time ago. And when something goes vertical based upon, I don't think I'm being exaggerative when I say insane government policies, well, I don't exactly think that's a buying opportunity.
Yeah, I included this chart. I thought it was interesting exactly for the reasons that you stated. Equities and commodities were, for most of the or a good portion of the period of this chart, were sort of running lockstep. And in the bottom panel, we added the Fed's balance sheet, and whether coincidence or not, probably not, there was a big divergence in S&P and
real estate. It sure looks like cause and effect to me. I mean, yeah, it's possible that they're unrelated and it's just a total coincidence, but my golly, we've often used in our macro meeting that we do every Wednesday, we've often looked at the ratio of the S&P 500 to the Fed's balance sheet. And I've commented on this for years, that line, it's almost a constant. It almost seems like a law of physics that the Fed's balance sheet relative to the value of the S&P 500 is a constant. So look, I've said this last summer. I said, it's fine to own stocks because you can add a zero to the price of stocks. You can't add a zero to the price of the long bond. I mean, the long bond's not going to go to a price of 1,000. So, stocks you can own because they can benefit from this Federal Reserve policy, and they have benefited from Federal Reserve policy. But now we're starting to hear tentative and indeed quickly walked back statements by people on the Fed and Janet Yellen and so on, saying that maybe we should start talking about tapering. Well, if the Fed doesn't continue fueling this money, this distribution of checks to the population, I think the stock market is doomed. I mean, if the Fed actually tapers its balance sheet, look at the fourth quarter of 2018, when the Fed started to try to taper its balance sheet and the stock market started tanking and went into one of the sharpest, quickest bear markets of all time until the Fed said no mas and went back to the activity that they're doing right now. And the stock market dutifully followed the Fed, and up it went. And so here we are now with a big bear market, the sharpest move from an all-time high in the stock market to a bear market in history back last March, and now it's being reinflated. Once the Fed starts talking about tapering, there's no hope for the assets that are dependent upon the Fed, and that would include also, if they taper, of course, bond yields must go higher. The Fed is the only buyer of bonds. Foreigners are not buying bonds, they're selling bonds. Domestics are not really buying bonds. Pension plans, what pension plan wants to load up on a 1.5% yielding treasury market when their actuarial rate is 600 basis points higher? Just to go full circle to where this conversation started, we are in the mirror image of when I started in this business in 1984, and yet wildly, we see signs everywhere that the conditions that led to the Jimmy Carter era are here again.
To go back to that starting proverb, may you live in interesting times, and we certainly do. I want to ask one last question before we open it up to some questions from the audience. And this is a question that I am very curious to hear. What keeps you inspired and involved in markets? You've had a long career, an exceptional career. What motivates you today as you think about markets and keep plugging away on the work that we do?
I want to see how the movie ends, and I want to try to help investors get through the fourth turning to the first turning. I've expected that this was going to happen. I've predicted it. I've talked about it in a way that a lot of people say, stop talking about this, and yet it keeps happening. And I want to see the first turning, and I want to get to it, and I want to help people get through it, and I want to get myself through it. And the best way to do it is to be in the game. So I'm still here. And I'm actually, as much as I dislike what's happening, I've expected it, so I'm not surprised, and I'm prepared to deal with it, and I'm trying to help people get through it, and that's what keeps me engaged.
Excellent. Well, thank you, Jeffrey. I think with you, I'm going to read a couple of questions from the audience.
All right.
The first one, let me just make sure I can paraphrase this. Jeffrey, do you think owning puts on treasury prices is a wise hedge for all the duration clients own in their portfolios?
I've never really liked that strategy because you got to be right immediately. The decay on your option price is brutal. When you buy options, you got to be right quick. And it's possible that the puts work, but I don't think the Fed and the Treasury Department are quite ready to let the yields go up soon enough that the puts will make sense. So I really don't like buying put options. The other thing, like people often say, if you're negative on high yield bonds, why don't you short them? And I say, because you got to be right immediately. I mean, it's not like shorting subprime that yielded, LIBOR plus 25 when LIBOR was very low. When you short junk bonds, you've got a high, well, it's not that high today considering they only yield 4%, but that's still, you got to be right quickly. So you got to take into consideration the carry that you're giving up, and the carry on puts is brutal.
And this sort of leads right off, this next question leads right off the previous one. And it's a question about the probability of yield curve control. And if you see that as a possibility, do you have, what line in the sand do you think the Fed might use? In other words, if yield curve control is something, where might that come into play?
I think yield curve control is already here. I mean, when the Fed is buying this incredible quantity of treasuries and mortgage-backed securities, they're obviously doing price control. When people talk about yield curve control, it's like, when will they say, we'll buy every bond there is? There's a level perhaps where the Fed says, well, if the economy can't take mortgage rates of, just pick a number, 4% or something, so we're going to make sure it doesn't get there. I think that yield curve control is blatantly in the game. Jay Powell himself, in a public forum, has repeatedly stated that yield curve control is a tool. So the guy who has the power to enact yield curve control has said, I will do yield curve control. So I don't know, maybe I'm being overly simplistic, but that to me says yield curve control is a real thing. And we had yield curve control back in the aftermath of World War II. Interestingly, at almost exactly the same yield levels that we're at today, on both the short end and the long end. So history does sometimes echo. And so what level will they do it at? We're not there yet, it appears, because we're now at a local high today on yields. And what's the level? I don't think anybody knows. I don't think Jay Powell himself knows, because to his credit, he should be open-minded and say, well, we'll see how things develop, and we're not going to have a preconceived notion without context. And so you're going to need a context. Where is that level? My guess is that they're not going to let the 10-year go towards up, probably not much up more than 2.5, just to pick a number. I'm sure they're not going to let it go to 5. I think with the inflation rate at 4.2, maybe it's transitory, but the real inflation rate might be 8, based upon the home prices as opposed to owner equivalent rent. Rates should be a lot higher than they are today, based upon the fundamentals. But the Fed is already in the game; they can do as much as they want, and sadly, that's the world we live in. So that's going to be my guess on yield curve control.
Great, thank you. And that's just about the time we have. I want to thank you very much for the chat. It was enjoyable. I've been waiting a long time to do this, so thank you very much.
Well, thanks, Sam. You do a great job, and we always enjoy going through the macro stuff together. So this was fun for me too.
Cool. Goodbye. Thank you.
All right, bye.